There is a specific financial conversation that happens at age 50. It usually starts with a number, the retirement account balance, pulled up on a phone or a laptop or a statement that arrived in the mail. The number is real. It is the result of years of earning, spending, saving inconsistently, and letting the financial decisions that felt non-urgent stay non-urgent for one more year, and then another, and then several more after that. And the number is not enough. Not dramatically wrong, not the result of obvious financial failure or irresponsibility, just not enough, given the timeline remaining, given the lifestyle it needs to support, and the compound interest math that would have made it significantly larger if the contributions had started 10 or 15 or 20 years earlier. The conversation that follows is about catching up, about what's possible from here, about whether the gap is closable. Sometimes it is, with significant changes to current spending and saving behavior. Sometimes it isn't. Not fully, and the retirement that was imagined needs to be revised downward in timing or in scope. This conversation happens millions of years every year, and it is almost always preceded by the same pattern, a set of financial decisions that wealthy people, the ones who reach their 50s and 60s with genuine options, made in their 30s, quietly and without drama, that average people kept deferring to some future point when the timing would be better and the financial picture would be clearer and the urgency would finally feel real enough to act on. The timing never got better. The picture never got clearer. The urgency arrived at 50 instead of 30, which is 20 years of compound interest too late to be the same conversation. This video covers 9 specific things wealthy people do in their 30s that average people don't start until their 50s, with the math that shows exactly what the 20-year difference costs and what starting now, at whatever age you're watching this, still makes possible. Before we get into today's video, I have one small request. If you enjoy content that helps you make smarter decisions and live a better life, hit subscribe and give this video a like. It helps the channel more than you know. Thing 1. They calculate their financial independence number and build everything around it. Most people save for retirement the way they save for a vague destination they intend to reach eventually. The account exists, contributions happen, more or less consistently, the balance grows, more or less steadily, the destination remains undefined, a sense of having enough, a feeling of security, a number that will announce itself as sufficient when it arrives. Wealthy people in their 30s don't save toward a feeling, they save toward a number. The financial independence number, the specific portfolio size required to sustain your desired lifestyle indefinitely through investment returns, is calculable with reasonable precision using the 4% rule, derived from the Trinity study. Multiply your desired annual retirement spending by 25. Someone who wants to spend $70,000 annually in retirement needs $1.75 million. Someone who can live well on $50,000 annually needs $1.25 million. The number is specific. It has a dollar sign in front of it, and it changes everything about how financial decisions get made. With a specific target, every financial decision has an addressable context. A raise becomes an opportunity to close the gap faster. A spending reduction translates directly into its impact on the timeline. The retirement date becomes a variable that moves based on identifiable decisions rather than something that happens when it happens. Without a specific number, saving feels like virtue without direction. You're doing the right thing without knowing whether the pace of doing it is sufficient. The wealthy person who calculated their number in their 30s knew at 35 whether they were on track to reach $1.75 million by 55, or whether the current contribution rate needed adjustment. The average person discovers the answer to that question at 52, when it is significantly harder to change. The calculation takes 30 minutes. The impact of having done it at 32 instead of 52 is measured in the difference between a retirement at 58 with options and a retirement at 68 without them. Thing 2. They max out tax-advantaged accounts before taxable investing. The difference between $1 invested in a tax-advantaged account and $1 invested in a taxable brokerage account is not a minor optimization. Over decades, it is one of the most significant financial decisions available to an ordinary investor, and it is a decision that requires understanding something about tax structures that most people were never taught. A traditional 401k contribution reduces taxable income in the year of contribution. Someone in the 22% marginal tax bracket who contributes $10,000 to their 401k reduces their tax bill by $2,200. That $2,200 is not saved, it is invested, growing tax-deferred until withdrawal. A Roth IRA contribution provides no immediate tax reduction, but allows the investment to grow entirely tax-free. Every dollar of gain, every dividend, every compounding return is withdrawn tax-free in retirement. Wealthy people in their 30s maximize these vehicles before putting money in taxable accounts. They understand that the tax drag on a taxable investment account, capital gains taxes on realized gains, taxes on dividends received, taxes on interest earned, meaningfully reduces the effective compound rate versus an equivalent investment in a tax-sheltered account. On a $100,000 investment growing at 8% annually, the difference between a tax-advantaged account and a taxable brokerage account subject to 15% capital gains rates produces approximately $180,000 in additional wealth over 30 years, created entirely by the tax structure, not by any difference in investment performance. The 401k maximum contribution in 2025 is $23,000. The IRA maximum is $7,000. A household with 2 earners can shelter $60,000 annually through 401k and IRA contributions combined. Most average households leave significant portions of this capacity unused while simultaneously investing in taxable accounts, paying taxes that the available sheltered vehicles would have deferred or eliminated entirely. Wealthy people fill the tax-advantaged buckets first, every time, before taxable investing, before most other financial priorities that don't involve high-interest debt elimination. The tax math is that clear. Thing 3. They build a board of financial advisors. Informal, but real. This is not about hiring a financial advisor, though that may be part of it. It is about the deliberate construction of a personal financial network, people whose knowledge, experience, and perspective on specific financial domains can be accessed when decisions arise in those domains. Wealthy people in their 30s understand something about financial knowledge that average people discover much later. No single person has comprehensive expertise across every financial domain that matters in a complex financial life. Tax strategy, investment allocation, real estate decisions, insurance optimization, estate planning, business structure, salary negotiation, career development. Each domain has depth that rewards specialist knowledge, and the cost of ignorance in each domain can be measured in thousands to tens of thousands of dollars. The informal board might include a CPA who understands tax optimization beyond basic return preparation, a friend or colleague who has navigated a specific financial decision, buying rental property, negotiating equity compensation, building a small business, and can share what actually happened rather than what the theory predicts. A fee-only fiduciary financial planner consulted periodically for structural decisions rather than ongoing portfolio management. A real estate professional who understands local market dynamics. An insurance specialist who can evaluate coverage adequacy without the bias of commission income from the recommendation. Average people make major financial decisions in isolation, with whatever information is available from a Google search and whatever instinct has developed from their own limited experience. Wealthy people in their 30s have already identified the people who know more than them in specific domains and established relationships that allow those people to be consulted when relevant decisions arise. The cost of building this network is primarily social. It requires the willingness to ask for advice, to be transparent about financial situations, and to invest in relationships with people whose knowledge exceeds your own in specific areas. The financial return on these relationships is consistently positive and frequently dramatic. The CPA who identifies a $4,000 tax deduction you didn't know existed, the real estate contact who prevents a $15,000 mistake in a purchase, the financial planner who restructures an insurance portfolio and saves $3,000 annually. Knowledge networks compound just as investment accounts do. The wealthy person who built theirs at 32 has been drawing on them for 2 decades by the time the average person realizes they need them. Thing 4. They understand and optimize their tax situation annually. The average American's relationship with taxes follows a predictable pattern. Income is earned throughout the year, taxes are withheld automatically. In February or March, a tax return is prepared, often by software, often using only the information that arrives in official forms, and a refund or a small payment results. The refund feels like a bonus, the small payment feels like an annoyance. The opportunity to significantly reduce the tax liability through proactive strategy goes largely unexplored. Wealthy people in their 30s treat taxes as an active management problem rather than a passive annual administrative task. The tax code contains a substantial number of provisions that reward proactive planning, deductions, credits, and structures that reduce tax liability significantly for people who understand they exist and take action to utilize them. Health savings accounts allow triple tax advantages: pre-tax contributions, tax-free growth, and tax-free withdrawal for qualified medical expenses. Contributed before year-end, an HSA can reduce taxable income by $4,150 for individuals, or $8,330 for families in 2025. Tax loss harvesting, selling investments that have declined in value to realize losses that offset capital gains elsewhere in the portfolio, can reduce capital gains tax liability by thousands of dollars in years when market volatility creates opportunities. Business owners and self-employed individuals have access to deductions, home office, vehicle use, equipment, professional development that salaried employees do not, but only if they are tracked and documented. The self-employed SEP IRA or solo 401k allows contributions of up to 25% of net self-employment income, dramatically higher than the employee 401k limit, sheltering substantially more income from current taxation for freelancers, contractors, and small business owners. The average household overpays taxes by thousands of dollars annually through failure to utilize available provisions. Wealthy people in their 30s have a CPA or tax strategist who reviews their situation before year-end when changes can still be made, not after, when the tax year is closed and the only remaining option is reporting what happened. Thing 5. They buy assets, not just things. This distinction sounds simple and is extraordinarily consequential in practice. A thing is a purchase whose value flows entirely at the moment of acquisition, the experience of having it, using it, enjoying it. Its financial value declines from the moment of purchase. It generates no income, it produces no return. When it is eventually sold, discarded, or worn out, it returns zero or a fraction of its purchase price. An asset is a purchase whose value continues to work after the acquisition. It generates income, appreciates in value, builds equity, or produces returns that compound over time. Its financial story doesn't end at the checkout counter. Wealthy people in their 30s allocate an increasing share of their financial resources toward assets and a decreasing share toward things. Not perfectly, they buy things too. They enjoy consumption, but with a deliberate awareness of the ratio and a commitment to ensuring that asset acquisition is a consistent priority rather than an afterthought funded by whatever remains after consumption spending is complete. The practical manifestations of this habit are varied. Regular investment contributions that acquire fractional ownership in businesses through index funds, real estate purchases that generate rental income and equity appreciation, skills development that increases earning capacity, a form of human capital investment that generates returns through higher income for decades. Intellectual property, a book, a course, a software product, creative content that generates royalty or licensing income without requiring proportional ongoing labor. Average people in their 30s buy things at roughly the same rate as their income growth, upgrading housing, vehicles, clothing, experiences, and consumer goods as income permits, with asset acquisition as a secondary priority, funded by whatever consumption spending doesn't absorb. The wealthy person's portfolio grows during these years. The average person's consumption standard grows. The financial divergence that follows is not surprising. Thing 6. They protect their income with disability insurance. This is the most consistently overlooked financial protection in middle-class financial planning, and one of the most significant financial risks most working people carry without realizing it. The most valuable financial asset most people in their 30s possess is not their investment portfolio, their home equity, or their retirement account. It is their future earning capacity, the stream of income their labor will produce over the next 30 to 35 years of their working life. For someone earning $70,000 annually, that stream has a present value of approximately $1.5 to $2 million over a working lifetime. Disability insurance protects that asset. It pays a portion of your income, typically 60 to 70%, if illness or injury prevents you from working. The probability of needing it is not trivial. According to the Social Security Administration, a 20-year-old worker has a 25% chance of becoming disabled before reaching retirement age. 1 in 4 working people will experience a disability that interrupts their income at some point in their career. The average long-term disability lasts approximately 34 months, according to the Council for Disability Awareness. For someone earning $70,000 annually, a 34-month disability without coverage represents $198,000 in lost income, plus the retirement contributions that weren't made, the investments that weren't funded, and the compound growth that will never occur on money that was never invested. A long-term disability insurance policy for a healthy 35-year-old typically costs $100 to $200 monthly, depending on coverage amount, elimination period, and benefit period. The annual premium of $1,200 to $2,400 ensures a $2 million asset against a 25% probability of significant impairment. The expected value calculation is unambiguously positive. Wealthy people in their 30s carry adequate disability coverage. Average people discover they don't have it or that employer coverage is insufficient at the moment they need it, which is the least useful time for that discovery. Thing 7. They negotiate everything consistently. Wealthy people in their 30s have internalized a single insight about how prices and compensation actually work that most people never fully absorb. Almost nothing is as fixed as it appears, and the cost of asking is almost always lower than the benefit of the answer. The salary negotiation is the highest stakes application of this habit. Research from Carnegie Mellon University found that failing to negotiate a starting salary cost the average worker $500,000 over the course of a career, not because they never received raises, but because every raise, every future employer's starting offer, and every bonus calculation is based on the previous salary as a foundation. A higher starting point compounds upward automatically. The person who negotiated their salary at 28 has been earning the benefit of that negotiation for decades by 50. But the negotiation habit extends far beyond salary. Insurance premiums respond to annual review and competitive quotes. Medical bills are reduced for approximately 67% of patients who ask, by an average of 35%, according to the Kaiser Family Foundation. Rent in markets with vacancy rates above 5% is negotiable, particularly for reliable long-term tenants. Car purchases have well-documented dealer margins that reward buyers who understand them. Credit card interest rates are reduced for customers who call and request reductions, a practice that works in approximately 70% of cases, according to creditcards.com. Average people treat prices as facts. Wealthy people treat prices as opening positions. The wealthy person who has negotiated consistently across all these categories for 20 years has retained $100,000 to $300,000 more than the person with identical income who accepted every initial offer, money that was available to both of them and captured by only one. The habit requires comfort with mild discomfort. The ask feels awkward. The possibility of being told no feels uncomfortable. The cost of the discomfort is approximately 30 seconds of awkwardness. The benefit is compounded over every similar transaction for the rest of your financial life. Thing 8. They live significantly below their means at every income level. This is the habit most directly separates people who build wealth from people who maintain a lifestyle. It is also the habit most aggressively undermined by every force in the consumer economy: advertising, social comparison, cultural norms around what income levels are supposed to look like in terms of housing, vehicles, clothing, and experiences. Living below your means is easy to describe and genuinely difficult to sustain because the pressure against it compounds with income growth. At $40,000 in income, living below your means might require genuine constraint. At $90,000, it requires resisting the lifestyle that $90,000 is supposed to produce: the nicer apartment, the newer car, the restaurants that match the income level. At $150,000, it requires resisting the lifestyle that $150,000 is associated with: the large home in the right neighborhood, the luxury vehicles, the premium everything. Wealthy people in their 30s resist this pressure with a specific structural approach. They automate the savings and investment allocation before the income reaches their spending accounts. The lifestyle is built on what remains after the wealth-building allocation, not on the full income. This sequencing means that lifestyle inflation is limited structurally rather than through willpower. You cannot inflate your lifestyle to income that never appears in your checking account. According to J.P. Morgan's 2024 Asset Management Guide, households maintaining a 20% or higher savings rate across income levels accumulated wealth at 3 times the rate of households saving 5 to 10%, despite similar incomes. The savings rate, not the income level, was the primary predictor of wealth accumulation speed. The average person in their 30s saves whatever remains after lifestyle is funded, typically 3 to 5% of income, according to Bureau of Economic Analysis data. The wealthy person in their 30s funds wealth building first and builds their lifestyle on what remains. Same income, different sequencing. Dramatically different outcomes at 50. Thing 9. They start a side income stream before they need one. The wealthy person's relationship with income is fundamentally different from the average person's in one specific way. They do not wait until their primary income is insufficient to begin building alternative sources of it. The side income stream started at 32 looks very different from the side income stream started at 52 under financial pressure. At 32, it can be built from interest and curiosity, a skill monetized, a hobby developed into something commercially viable, a professional expertise leveraged in consulting or freelance work. The pressure to succeed immediately is low because the primary income is covering the financial obligations. The iteration time is long because 2 decades remain to build something meaningful. At 52, the side income stream is often being built from necessity to supplement a retirement account that isn't on track, to create the financial margin that income growth never produced, to build something generating income before the primary income stream ends. The urgency is real, the timeline is compressed, and the tolerance for the slow, early phase of any income-generating venture is significantly lower when the need is immediate. According to research published in Inc., 65% of self-made millionaires have at least 3 income streams. These streams were not typically built simultaneously from a standing start. They were built sequentially, over years and decades, starting when the primary income was stable enough to provide the time and financial cushion for experimentation. The specific form of the side income stream is less important than the timing of its construction. A rental property bought at 33 has generated 20 years of equity and rental income by 53. A content platform built at 31 has 2 decades of audience compounding by 51. A consulting practice started at 34 has 18 years of relationship development and reputation building by 52. Wealthy people in their 30s are not primarily motivated by the income the side stream generates at 32, 33, or 34. They're motivated by what it becomes by 52 and by the financial independence that multiple income streams create that a single income stream, however large, cannot replicate. 9 things. Not theories or aspirational principles, specific behaviors with specific financial consequences that are measurable, documented, and consistently present in the financial histories of people who arrive at their 50s with genuine options rather than genuine constraints. Calculating a specific financial independence number and building toward it. Maximizing tax-advantaged accounts before taxable investing. Building a network of financial expertise to draw on, managing taxes proactively rather than reactively, buying assets alongside things, protecting income with disability coverage, negotiating consistently across every relevant category, living significantly below their means at every income level, building side income streams before necessity creates them. The 20-year difference between doing these things at 32 and doing them at 52 is not primarily a knowledge difference. Most people reading or watching personal finance content know at some level that they should be doing most of these things. The difference is the urgency with which the knowledge is acted on and the compound interest math that makes urgency at 32 worth approximately twice the urgency at 42. The conversation that happens at 50, the one that starts with a number that isn't enough, is not inevitable. It is the predictable outcome of a set of decisions that were available earlier and deferred for reasons that felt reasonable at the time. The decisions are available right now, at whatever age right now represents for you. The compound interest math doesn't require that you started at 30. It requires that you start before tomorrow. What that looks like specifically, 1 account opened, 1 contribution automated, 1 number calculated, 1 negotiation initiated, is less important than the decision that it happens today rather than at some future point when the timing is better. The timing is never better. The starting is always now.